Remember 2020? Interest rates were at a historic low. We're talking record setting, once in a generation lows, and Canadians rushed into variable rate mortgages because it seemed like the safest bet. Rates were low. The Bank of Canada was saying that they could stay low for a very long time, and it felt like you couldn't lose. But then 2022 happened. The Bank of Canada hiked interest rates at the fastest pace in history, and borrowers who thought that they were safe in variable rate mortgages got absolutely crushed. Their payments jumped overnight. Families saw hundreds, even thousands of extra dollars coming out of their budget each month, and for many, it was devastating. Fast forward to today, and we're finally starting to see hints that interest rates could start coming down. Inflation is easing, bond yields are moving, and optimism is creeping back into the market. And right on cue, people are asking the question, should I go variable this time? On the surface, it is tempting. If rates fall, your payments could go down too. The idea of riding the wave down feels smart, like you're taking advantage of the system. But here's the problem. That exact thinking is what burned so many borrowers just a couple years ago. The truth is, choosing between fixed and variable isn't just trying to outsmart the market. It isn't about guessing where interest rates will be in the next 6 months or even a year. It comes down to one thing, and that's your risk tolerance. And risk tolerance isn't some abstract concept. It's real. It's about whether your household can handle payments that go up without warning. It's about whether you can sleep at night knowing your mortgage could change because of a headline, an inflation report, or a decision made in Ottawa. Think back to 2020 and 2021. The Bank of Canada itself was saying that rates could stay low for years. Every economist on TV seemed to agree. But what actually happened? Rates skyrocketed. Predictions were worthless, and the families who relied on those predictions instead of their own financial comfort zone paid the price. That's why the very first lesson when considering a variable rate mortgage is this. Do not make your decision based on forecasts. Make it based on what you and your family can actually handle. If your budget is already tight, if your job feels uncertain, or if the thought of fluctuating payments makes you nervous, then a variable rate mortgage is almost certainly not the right move. Because at the end of the day, no YouTuber, no economist, no bank executive has a crystal ball. Nobody can guarantee you where rates will be in 1 year, let alone 5. The only thing you can guarantee is how much volatility you're personally willing to absorb. So before we dive into the specific reasons why variable rate mortgages are risky this year, I want you to keep this framework in mind. This isn't about trying to time the market. It's about making a decision that allows you to stay in control, no matter what happens next. All right, so now that we've set the stage, let's dig into real reasons why you shouldn't choose a variable rate mortgage this year. I'm going to walk through 5 key points, each one based not just on theory, but real world examples, real numbers, real mistakes that borrowers have made in the past. And if you stick with me, you'll see why variable rates sound good in theory, but rarely work out in practice, especially right now. Reason number 1, market timing is almost impossible. So here's the thing. Everyone thinks that they can predict where interest rates are going. People watch the news, they follow economists, they look at bond yields, and they convince themselves that they have cracked the code. But if the Bank of Canada itself couldn't predict 2022, what makes you think that you can? In 2020 and 2021, the Bank of Canada literally told Canadians that rates would stay low for years. Family made life-changing decisions based on that. They stretched their budget, they bought bigger homes, they locked into variable rate mortgages thinking this is safe, rates won't move. And then rates didn't just move, they skyrocketed. Overnight, budgets were destroyed. And here's what's important. The people who thought that they were timing the market were the ones who got hurt the most. Now let's apply this lesson to today. Fixed rate mortgages are sitting around 4% and variable rates are sitting around 4.5%. For variable to be worth it, rates would need to drop by at least a full percent, and they'd have to drop quickly enough to stay low long enough for you actually to come out ahead. Do you really want to bet on your family's financial security on that happening? If you're wrong, you're paying more every single month for years, and that's not a smart gamble. Reason number 2, payment shock is real. This is the one that kept me up at night when I watch clients go through 2022. Payment shock is when your mortgage suddenly jumps by hundreds of dollars overnight because of the Bank of Canada's decision. For adjustable payment variables, that happens instantly. The moment rates go up, your payments adjust. For fixed payment variables, the kind most of the big banks sell, the story is even scarier because your payments don't go up right away. Your amortization just stretches out quietly in the background. You feel like you're safe, but you're not actually paying down your mortgage. And then renewal, all of that deferred pain hits all at once. Families who thought that they were fine suddenly saw their payments jump by $7, $8, or even $1,000 a month at renewal. That is the definition of payment shock, and that has ruined budgets across the country. If the thought of your payment jumping like that makes you nervous, and it should, then variable probably isn't the right fit for you. Reason number 3, relationship stress. This one doesn't get talked about enough because I see it all the time as a broker. Mortgages aren't just math, they're emotional. And if one partner in the relationship doesn't feel comfortable with risk, a variable rate mortgage can create a lot of tension. I've seen couples who argue constantly about money because one person pushed for a variable and the other didn't want it. When payments rise, the blame game starts. That kind of stress doesn't just hurt your finances, it hurts your family. That's why I often tell clients, if one of you isn't comfortable with variable, then just simply don't do it. It's not worth risking the peace of mind or your marriage just to maybe save a few $1,000s in interest. Reason number 4, short-term fix is often the better option. Here's a little strategy most people don't know about. Sometimes 1 or 2 year fixed rates are actually cheaper than variable. And when that happens, they give the best of both worlds. You're getting a lower rate, so you're saving money immediately, but you're only locking into a short term. So if rates come down, you're in a position to take advantage of it. My wife and I did this back in 2011. We chose a short term fixed because it was cheaper than the variable, and it gave us the flexibility to move when the market shifted. That strategy saved us thousands of dollars. So before you sign into a variable today, take a close look at what availability is on short-term fixed side. In a lot of cases, it's simply a smarter move. Reason number 5, not all variables are created equal. This is the part that most people don't understand. There are actually 2 main types of variable rate mortgages. The first type is adjustable payment variable. With this one, your payment goes up or down when rates change. It feels scary when rates rise, but here's the good news. Your amortization stays intact, and you keep paying down your mortgage properly. The second type is the fixed payment variable. This is the one big banks love to sell. It looks safe because your payment doesn't change when rates rise, but in reality, your amortization stretches further and further. You're paying less and less towards the principal, and you're setting yourself up for massive payment shock at renewal. And here's the kicker. If you want to lock in your variable at the big banks, you often don't get the best fixed rates available. They lock you in at higher than market rates, which means you're trapped in a product that you never really benefited from. That's why working with a broker matters. A good broker will guide you towards the product that actually makes sense and keeps you away from the ones designed to trap you. So when you add all of this up, what do you get? You get a picture of risk, uncertainty, and hidden traps. Variable mortgages look good when you read the headlines. They sound appealing when economists say rates might come down, but in reality, the math, the psychology, and the structure of the product themselves are stacked against you. It's not that nobody should ever take a variable. There are some situations where it can make sense. But for the average Canadian this year, the risk far outweighs the reward. So when you hear someone say variable is the smart move because rates are going to drop, just remember this. We've been down this road before and it didn't end well. So now that we've broken down all of the risks, let's talk about the big picture. Here's the bottom line. Variable rate mortgages only make sense if 2 things are true. Number 1, the variable is actually cheaper than the fixed. And number 2, you and your family are genuinely comfortable with risk. If either one of those conditions isn't met, you're better off steering clear. So right now this year, we don't have either of those conditions. Variables are sitting higher than fixed, which means you're paying a premium just for the chance that rates might fall in the future. That's not a winning formula, that's a speculation. And when it comes to your home, speculation is the last thing you want to be doing. Now, here's another piece that people forget. Your mortgage isn't just about interest, it's about stability. It's about predictability. It's about protecting your budget so that you can focus on living your life, not stressing about whether your payments will change every few months. Think about it like insurance. You don't buy car insurance or home insurance because you think something bad is going to happen. You buy it because you want to know you're covered if it does. A fixed mortgage works the same way. It locks in your payments and gives you certainty, and it takes that stress off of your shoulders. And here's the truth. There are ways to play offense with your mortgage without exposing yourself to unnecessary risk. Short-term fixed options are one of them. They let you ride the current environment without overcommitting. You can also structure your mortgage with prepayment privileges so that if rates come down, you've got flexibility to take advantage of it. The key is to make decisions that puts you in control, not one that hands control over to the Bank of Canada. Because when you're in a variable, that's exactly what you're doing. You're tying your monthly payments to decisions made in Ottawa that you have no control over. And here's something I tell my clients. The goal isn't to win the mortgage game. The goal is to make sure that your mortgage works for you and your family. If you can lock in a rate that keeps your payments affordable, lets you sleep at night, and gives you confidence in your budget, that's a win. So should you choose a variable rate mortgage this year? For most Canadians, the answer is no. Not because variable rates are always bad, but because the conditions just aren't right and the risk simply is too high. If you want help figuring out the best strategy for your situation, reach out. This is what I do every day. I help families across Ontario make smart mortgage decisions that keep them safe today and set them up for success in the future. Don't gamble on variable. Choose stability, choose peace of mind, and choose a mortgage strategy that actually works for you. I'm Justin Chausse. I've put a link in the description. I'd love to chat with you about what the best strategy is. Thanks for watching, and I'll see you in the next video.